Welcome to An Ounce of Prevention, the podcast. At our Reese & Associates, we believe that an ounce of prevention is worth a pound of cure. Our daily commitment lies in informing our clients about legal risks without hindering their business objectives. As we like to say, we're in the business of building companies and helping executives sleep at night. So stay tuned. Maybe you'll learn something that'll help your business grow and thrive.
Hi, I'm Rachel Reese. Today we're talking about NDAs, also known as non-disclosure agreements or confidentiality agreements. After the episode, stick around for our much-loved case law update. NDAs are used for a variety of things. You can use them with employees to ensure they don't steal company confidential information or trade secrets, or you can use them with potential investors or business partners when sharing information about your company that you don't want spread around. Today, we're going to talk about NDAs in the context of buying and selling assets. You typically see these NDAs as a requirement to access information in a data room. But today I'm going to talk you through some of the pain points that we see when we're working on these types of NDAs and give you some tips for how to deal with them. And when you're dealing with a lot of NDAs at once, either on the buy side or the sell side, consider RRNA. We're a cost-effective solution for getting these across the finish line so that they don't pile up on your desk, usually within 24 to 48 hours. Okay, let's get started. Attention, all you deal makers in the Houston area. Get ready for the inaugural Dealmakers Haunted Hall Gala on October 23rd at Meow Wolf Radio Tav. It's going to be a night of networking, giving back, and some spooky thrills. The Dealmakers Haunted Hall Gala is your chance to meet with industry leaders while making a real impact on the communities we serve. This event isn't just about fun, it's about giving back to those in need. We're looking for sponsors to help make this event a success. With sponsorship levels ranging from $2,000 to $5,000, every contribution goes towards supporting local communities and making a difference where it matters most. The more sponsors, the greater the impact. We need your help to make this unforgettable. Visit www.rreeselaw.com for information about events, tickets, and sponsorships. Email rlamphere@rreeselaw.com to sponsor and be a part of something bigger than just an event. Let's make Halloween one to remember. Dealmakers Haunted Hall Gala, where the networking meets charity in the spookiest way possible. Let's start with something that sometimes gets snuck by people, which should not be in this type of NDA. It's a non-solicit provision. In this scenario, a non-solicit provision is going to state that you agree that you're not going to solicit the other company's employees for a certain period of time. While this provision is fine in some contexts, if we're talking about an asset sale, it doesn't belong in there. The next sneaky thing that sometimes happens has to do with non-compete clauses. The scenario is this. The seller tries to get you to agree that you're not going to compete with them within the area that's shown on Exhibit A. This is usually okay, but the trick is that sometimes people agree to it without being provided Exhibit A. What if Exhibit A includes the entire Permian Basin? And not just what the seller is selling. There are some other limitations that you'll want to put on non-compete clauses, depending on the type of company you are, but this is the most obvious issue that we see a surprising amount of the time. So another issue you want to be careful of is who your affiliates are, who your representatives are, and what you're binding them to. Does your private equity backer count? Well, what if they have a seat on your board? Because I guarantee you, your private equity backer does not want to be included in the definition of an affiliate. Are you agreeing that your affiliates and representatives will sign a separate NDA in order to be shown the materials? We're talking accountants, consultants, attorneys. Who's going to manage all that paperwork? And there's another issue that could result in a lot of paper pushing on your part if you don't get it right. And that's the return or destroy clause. In this clause, the sellers sometimes say that it's the obligation of the potential buyer to return or destroy all the confidential information that was provided to them when the NDA terminates. We like to remind our buyer clients that they don't have the time or the manpower to have someone monitoring these deadlines for them and gathering up all this information for every NDA that they've signed. The typical way we suggest this be handled is to require that the seller send a notice if they want things returned or destroyed. And the thing is, that rarely happens because by the time the NDA terminates, usually around a year later, the seller doesn't care about this asset anymore. There's also exceptions to the return and destroy requirement that everyone should be aware of. First, there's mental impressions. It's well established that you can't make people give up their mental impressions of what they saw, but it's a good idea to document this exception in your NDA. Next, if you're a buyer, You typically want an exception that allows you to keep the materials that end up on your data backups and your management presentations, or that have to be kept because of compliance or governmental reasons. This all gets pretty technical, and you want to make sure your language is tight on these issues. I know a lot of folks feel comfortable doing NDAs themselves, especially when they need to get them done quickly. But like we say, an ounce of prevention is worth a pound of cure. So consider finding a law firm partner that you can work with, even if it's not us, to make sure you're hitting all these pain points in your NDAs so you don't get into a situation that you never intended to. Well, that's it for today, and I hope you learned something. If you want to be a guest on our show or have questions or ideas for the podcast, please email us at podcast@rreeselaw.com. And now it's time for another case law update. Today's case is a recent ruling from the Supreme Court of North Dakota called Higgins versus Lund, and is yet another fixed versus floating royalty case. This case involves a title dispute in Williams County, North Dakota. In January 2017, the Higgins Plaintiffs sought a judgment to quiet title to mineral interests and to recover oil and gas proceeds. The Lund Defendants denied the allegations and asserted counterclaims seeking quiet title to the minerals. The case centered around a 1964 warranty deed and a 1952 royalty deed. For today's update, we are going to focus on the North Dakota Supreme Court's analysis of the 1952 royalty deed. I'll start with the end. The court determined that the 1952 deed unambiguously conveyed a floating royalty interest. This means that the royalty interest would fluctuate based on the terms of any future oil and gas leases, rather than providing a fixed fraction of production. But how did they get there? Well, the court explained it in these terms. When you are talking about a floating royalty, you are talking about a fraction of a royalty. And when the royalty itself changes, the fraction therefore changes. So the fraction is tied to something, like the underlying lease, and usually depends on multiple fractions in order to calculate it. When you are talking about a fixed royalty, you are talking about a royalty that is a fraction of something else, usually proceeds or production. Here, the royalty language in the 1952 deed was 8% of the royalty and was tied to the underlying lease. Therefore, the court determined that it was a floating royalty. So why does this case matter? When designating royalty interests, the addition or omission of just a single word can fundamentally alter how royalties are calculated and distributed. These cases are popping up all the time, and we are finding over and over again that the drafters of some of these old deeds were not as precise as they could have been. So as the fixed versus floating royalty issue evolves, we will keep you up to date, right here on An Ounce of Prevention. I'd like to thank Miguel Otero, a law clerk in our Dallas-Fort Worth office, for his help on this update.
The information and material in this episode is general information about our practice and firm and is for educational and informational purposes only. This information does not offer specific legal advice, and the use of this information does not create an attorney-client relationship with RRNA or any of its attorneys. The information in this episode, or any episode of An Ounce of Prevention, should not be considered legal advice, and persons should not act upon this information without first engaging professional legal counsel.
Thank you for listening to An Ounce of Prevention, presented by R. Reese and Associates. If you found this episode informative, subscribe to, rate, and review our podcast on Spotify, Apple Podcasts, YouTube, or wherever you listen to stay up to date with future episodes, case law updates, and breaking news. If you have any questions or are interested in learning what RRNA's outsourced legal department can do for your company, reach out to us at podcast@rreeselaw.com. That's podcast@rreeselaw.com. Follow us on LinkedIn or call 832-831-2289.